Hi there, my name is Charles Goddard, and I just wanted to introduce you to the Alpha and the Omega of Trading, which is a series of lessons that I've put together for the average person, for the rank beginner. That doesn't mean that if you've been trading for a while and not been that successful that you wouldn't get anything out of it. It's for anybody that's got question marks around the efficiency and the success of their trading. So first, all I'm trying to do with this little video is to show you that the stock market is not some big mysterious entity that is there just to gobble up your money as you take runs at it with various tips and things that you've been given by friends and around the office and so on. I'm going to show you that you can invest profitably and confidently with just a few basic tools that through the lessons I will teach you. And we're going to go through a couple of those lessons with slides right now, so that you can see what I mean. So what you're looking at here is a my chart setup. This is the setup that I use every day to look at various things, whether it's stocks in the stock market, whether it's oil and gold, or whether it's cryptocurrencies. Is exactly the same. I use typically a candle chart, which means the price is the daily price, in this case, of Apple, is depicted by a series of candles, which have a whole bunch of information contained in each one, which I will show you. But the main thing is the chart that I use is basic enough that you can set this up from any platform that you may use to trade stocks. You can get this from stockcharts.com for free, which is where I got this one. You can get free charting service from Yahoo as well. Now there's lots of places that you can buy charting services if you want to spend a few dollars and have a few more bells and whistles. But the whole point of this exercise is to show you that you don't need all those bells and whistles. So what you can see here is, and this is what I'm setting out to demonstrate in this video, is that I have got just momentum indicators at the top and bottom. I've got the price reflected in the series of what's called candles, and I have moving averages. Those are three thin colored lines that you can see that smooth out the price for me. And what I'm going to do now is I'm going to show you a very simple trade method. And what I want you to take on board is that you can see it and you can act on it. You don't have to make a decision about whether the company is a good company or not. All we're doing is trading from price action in a perfectly objective way. So what I'm going to do is I'm going to magnify a section so that you can see what I'm talking about a little easier, and we'll take a look at that on the next slide. Okay, so let's take a look at the chart where I've blown up the section in the middle. You can probably see the resolution's not that good, but that's not important. On the left-hand side, you'll notice that the thin colored lines that I mentioned before, which are moving averages, which smooth out the price for us. So the red is, in this case, an 8-day moving average, the blue is 21, and the green is 55. Now, very simple system is you look at your charts in the evening after the market's closed, and you see that the red line has closed above the blue line. So this is our signal that we can buy this the next day, which we would put in a trade to buy, and then When the next question then is, when do we get out? One, we can be stopped out, which I'll explain in a second, or two, we can, when the price, you get back one night and you look and you find the price has closed below the 21, i.e. the blue line, and if it's closed below that blue line, we're out. And then we wait for the red line to go above the blue line again, and we're back in, and so on. And you can see this example on the left hand side, and on the right hand side there's a big drop in price, and then as it rises up again you can see the red line rising above the blue line. That's our signal to get in, and I think you can see how objective this is. We're just going with what we see. I show you how to do the setup. There's a lot more things that you will learn over the 5 lessons that will still keep you basic, but will give you a lot more trading arrows for your quiver. The next thing we need to deal with is how to protect yourself, and we're going to deal with that on the next slide. This is an aspect of trading, and especially amongst so-called amateurs, is this idea that once you've placed a trade, it's going to go where it wants to go, and you're going along for the ride. If it's up, that's great. If it's down, well, that's the stock market for you. That's not how it works. Every trade I place, and if you're involved in my lessons, every trade you place from now on will have a stop loss that goes with your trade. Now, a stop loss is quite simply a set price where you want out of this trade. In other words, it's not going our way, and we want to get out. So I'll show you how to take logical places to put your stops. Logical meaning we have to let the trade breathe, but if our price goes below what we call support, we want out of this trade. So just to give an example, let's say we buy Apple at $100 a share, and our logical place to put our stop is at $90. That is done automatically. That price hits $90, we're out automatically. We're not going to think about it. It's done, and the trade is over. And there are different variations of stops that are absolutely fantastic. You do not have to accept the idea that if a trade goes bad, that you just have to choke down the losses until it stops losing. That's ridiculous. And I'm going to show you how to use stops. And the basic idea here is that if you let your winners run and you get out of the trades that aren't working, you can be wrong a big percentage of the time and still make money. Now, how good is that? Now, the second aspect to protecting yourself is capital allocation. Now, these two things that I'm talking to you about on this slide are more important than actual investment selection. And so you need to stick to this. It needs to be part of your process. We're going to start out with a very modest process, but I'm going to show you in the lessons how to build a process for yourself. But these two things need to be in your process like now if you're trading in the markets. Capital allocation is a big one. So let's say that you've got a portfolio of 100,000, just to keep our math easy. You should be having no more than 10% of that in a single trade. So in the case of our Apple example, you should be buying no more than $10,000 worth of Apple. Now, on top of that, you're going to place your stop so that if this trade is a loser, you lose no more than 2% of your portfolio. So you're going to place your stop so that if you are stopped out, you have lost 2% or less of your portfolio. So that's the combination. 10% of your portfolio in a position, in a single position, but you cannot lose more than 2%. You're going to place your stop in that way that you can only lose 2% per trade. Now, if you use percentages, then if you have a series of losing trades, which everyone will, then the percentage will cause you to invest less and less for each trade, and it will keep you in the game, as they say. If your trades are successful and expand, so do the size of your trades. 10% of 110,000 is greater than 10% of 100,000. So this expanding and contraction of your portfolio then dictates the size of your positions, and you won't blow yourself up. So if you get nothing else out of this little intro, if you go no further with this, please pay attention to these two things and respect them and make them part of your investing process. So now I'm gonna just show you what I would consider logical places for stops on the next slide. Okay, let's take a little look at our lifesavers, otherwise known as stops. You can see on the left-hand side two places where you might have entered trades where the red moving average has crossed above the blue moving average. Now, as soon as that has taken place, you are going to place a stop loss. That is the level under which we want out. So you can see the black lines. Those are two places where you would have entered trades, and you can see these black lines with the clever yellow circles around them. So this indicates places where there's support, where there was a fight between the buyers and the sellers, and it's where the buyers won. But if we drop below that level, it means the sellers are winning and we want out. So we set our stop loss at places like this, rather than just willy-nilly or rather than just a percentage. We're looking for logical places to put our stops. This will prevent us from losing big on any one trade and keep you going. You can see that. I think you can identify it. I'm hoping you're getting the idea that even if you're not familiar with these things at all, that you can be taught objective ways to trade and invest, and that you can do a better job with a little bit of time and effort than the indifferent professional that is currently looking after your account. Okay, well, thank you for taking the time to listen to me, and hopefully our paths will cross again. Thank you.